I don't need to tell you, there's a lot of happy talk about the global economy and financial markets here in Davos. You've said it, Goldilocks. I've heard it from a lot of other people. But you're already looking forward to the next downturn and even to the election in 2020. How come?
Well, we always have cycles. I mean, so we are in a perfect situation, right? Inflation is not a problem. Growth is good. But we have to keep in mind what part of the cycle we're in. The capacity utilization, the unemployment rate. So we're going to have
where are we? Where are we in that?
We're in the late stage of the cycle where, that's a period of time that might go for 2 years or something in that vicinity. When the operating rate gets high enough that the central banks think that they should begin to put on the brakes, that's where...
Take the punch bowl away.
That's right. In other words,
to use
it's like
euphemism, right?
Economic capacity is built at a certain rate. And then there's the growth in demand. So think of that as like driving behind a truck that's, the truck is going at 50 miles an hour. And if you're driving at 70 miles an hour, that's fine until you get close to that capacity rate. Then you can't have the car or the economy drive at that same 70 miles an hour. It's got to slow down. And so the central bank starts to put on the brake. And that's the part of the cycle. So from 2008 until central banks started to put on the brake, we had one kind of an environment. So now we are closer to its capacity constraints. And with that closeness to its capacity constraints, we're going to have a lot of stimulation. And that stimulation is going to look great. It's going to be great. But particularly short-term stimulation in the form of all the things that we know
Tax
happen.
reform, for example.
All the tax reform, what it means for corporations. And there's a lot of cash on the sidelines. Investors have cash on the sidelines. Banks have cash. Consumers have cash. And they can feel that they're being left out. It feels stupid to own cash in this kind of environment. So I think that that's going to be great for earnings. And it's going to be great for that stimulation of growth. And we have to look just beyond that to say, what is monetary policy going to be in that? And how difficult is monetary policy? So now let's take a look at that. Because we could look at step one. That's kind of the blow-off stage of everything.
Well, hang on. Before we get to monetary policy, for how long do you think we're going to, let's call it, enjoy this perfect environment? And when I say we, I don't mean just the financial community. Clearly, that's good for risk assets. If earnings are going to be great, presumably that's good for stock prices, right?
Yeah.
But companies are raising wages, they're doing some hiring, they're doing some investing. So some of it's trickling down to, let's call it, the real economy. So how long will people be able to enjoy that?
I think that spurt, and if you look at all that's in it, will be a 12 to 18-month kind of spurt. And then, while that's happening, then the central bank will have to tighten monetary policy.
And it will feel as though it has to tighten monetary policy.
It will feel like it has to tighten monetary policy. And with that, it's very delicate, because if you look at the history, there is if there's a tightening of monetary policy so that interest rates rise at a rate that's faster than is reflected in the curve.
The yield curve, right?
The yield curve.
It's a surprise.
It's a surprise. And what I mean is, you could look at what the interest rate is discounted for every month forward for God knows how far. And all assets are priced off of that. In other words, you know how a bond is priced off of that. You know how equities are priced off of that. All assets, private equity, all is priced off of that. So if it rises faster, historically we've seen this, when it rises faster than is discounted in the curve, it's a negative because it has a negative present value effect on asset prices. In addition, there's the slope of the yield curve, which matters. Because, and if you look at where 10-year rates are, let's say 2.6%. As you start to get closer to that, and that yield curve flattens, then that causes a constraint in the economy and a constraint in lending. So we have a situation now, because of assets having a long duration, there's a sensitivity to that. There's also a lot more interest rate sensitivity in the economy. Assets themselves are more sensitive, like a 1% rise in bond yields will produce the largest bear market in bonds that we've seen since the 1980-81 period.
Has that bear market started? Are we in it?
I think we're in it.
We're in it.
Yeah, so I think we're
early
in
stages.
I think we're in an environment which is really good for stocks and bad for bonds, and that kind of blow off.
When did we enter that bear market? When the 10-year crossed 2.5?
Well, we know, I mean, we know where the bottom was, okay? And
True.
So it depends how you define a bear market. So what I'm trying to say, I think, is monetary policy will be delicate, not to affect interest. I think the Fed will not only tighten at a rate which is faster than is discounted in the curve, I think they'll tighten at a rate which is probably faster than they are even signaling.